Howdy, partners. Last week we talked about Chuck Akre and his three-legged stool. Today we're going to talk about three compounders from his portfolio to buy in November. So let's get in here and let's get started. If you missed that video, Chuck Akre is an investor that's really well known for finding great businesses and holding on to them for a long time. His framework's a three-legged stool, and it's a simple system for picking high-quality companies that can grow for a long time. It's very similar to kind of the Francois Rochon idea. He buys great companies, he lets them grow, and he doesn't sell them too soon. The three-legged stool, the three legs of the business, the management, and reinvestment. And if you get those three things together, then you wind up with a compounding machine, according to Akre. And his results say that he is correct. He's beaten the S&P over long periods. He's had really impressive returns. So this is not a bad framework to work from. And the business, basically what he's looking for is something that is understandable. It's simple. It has good returns on reinvestment. It's got some kind of competitive advantage or pricing power, and a strong balance sheet. Now for management, he wants, somebody with some skin in the game. He wants to be treated like partners. He looks for really good company cultures, and he wants to make sure that they're allocating capital properly. And then third, he wants to see that they're reinvesting in the business and in a disciplined way. And the other thing he wants is a nice long runway so that business can keep growing. If we have a great business and a great management, but it's got all the market share it's going to get, or there's nowhere to go, then we're not going to wind up with great results. So now that you know that, let's take a peek at his portfolio. And you can see this is the result of holding businesses for a long time. He's got MasterCard at 18%. Brookfield's over 10, KKR is over 10, Moody's is over 10, Visa is over 10%, O'Reilly's at 8. This is a pretty concentrated portfolio, and these are not positions that have been bought at giant starting weights. These are positions that have grown into those large weights because they've compounded and he's held. So as I look through this, I'm looking for businesses. Obviously, these all match his three-legged stool framework, but what I'm looking for, I want a business that pays a dividend, and you can see a lot of these do. But I also look for businesses that were pretty easy to understand and things that were selling at what I consider at least a reasonable valuation. So with that said, let's look at the first business that I picked out. This is a smaller position. This is Danaher. And what these guys do is they make tools and equipment for medicine and science. So you can think lab equipment, diagnostics, biotech equipment, that kind of thing. So scientists, hospitals, medical labs all rely on their equipment. And these are fields that over time should grow. Science discovers new things, medicine advances, we have new tests, we have new things to look for, and this business should grow along with it. So if we look at revenue and operating profits, we can see that it's maybe a little cyclical. There's some dips, but the overall trend is pretty strongly up there. And as far as why it can keep compounding, well, it's got a huge role in science and healthcare, which, like I said, has a steady and growing demand. They have the Danaher business system, which keeps improving the business. This is kind of a Toyota continuous improvement idea where they're standardizing things, they're looking for ways to improve, and when they find it, they spread it throughout the business. There's also a serial acquirer, so they tend to buy high-quality life science companies, and then they grow and improve them. They put that business system on, they get them on that continuous improvement track, and what they buy as a good, high-quality business becomes a better business once it's inside. And last, healthcare spending is just going to grow as the world ages and needs more treatment. So as the world innovates, discovers, and cures diseases, and science and healthcare keep moving forward, this company is going to go right along with them. As far as valuation, the way that I looked is a quick kind of relative valuation. This is just the dividend yield compared to the history. And you can see, compared to the recent history, this doesn't look ridiculously valued. In 2017, it looks like it was pretty cheap, but after that decline there in dividend yield, this is trading at the top end of where it's been in the last few years. So could be a reasonable valuation. Number two, this is one of the larger positions, is Moody's. These guys rate the credit of businesses and governments. So if a large business or government wants to issue debt, Moody's is one of the companies that they're going to get a rating from to decide how safe that debt is and what kind of borrower they are. So they also sell financial data through software called Moody's Analytics. So that's also a pretty stable market. Again, revenue, operating income, pretty steady upward trend. We could see that compounding. And as far as why, well, this company is almost impossible to replace. The credit rating business is really an oligopoly, with Standard & Poor's and Fitch being the other participants. That's pretty much the whole ball game right there. Those are the companies that if you want debt, that you're going to get a rating from. So it's a necessary service. Banks and investors rely on these ratings. This is a standardized system. It's well respected. They've got a great reputation. So this is a needed service, and that high margin subscription data service is growing pretty fast. So that's going to help them continue to compound in the future. And Moody's can raise prices over time because that demand is steady. And like I said, it's an oligopoly. So there's not a lot of competitors out there. And if you're a big company and you're serious about raising debt, if you don't have credit ratings from at least a few of these companies, there's going to be a big question why. It looks like you're hiding something. So as long as borrowing exists, Moody's is going to get paid, and that probably is not going to stop anytime soon. Their dividend yield chart looks pretty similar to the last one, actually. So there was kind of a downtrend, but considering recent valuations from, since, 2019, 2020, this is somewhere in the mid-range of where it's traded on a dividend yield. So again, an indication that it might be at least reasonably valued, maybe not screaming cheap, but at least reasonably valued. And before I move on, maybe I should explain why I looked at this as a valuation metric. And the reason is pretty simple. It's because the dividend payment is stable over time. That tends to increase a little bit, over time, but it's not moving around all over the place. So the thing that does move is the stock price. So a declining stock price is going to give us a higher dividend yield, and an expensive stock price is going to give us a lower dividend yield. And the theory is, whenever there's a certain dividend payment out there, the valuation can only get so far off of that before that dividend payment pulls it back in. If a company like Moody's, the stock price keeps declining, and all of a sudden, instead of a 1% or a 0.8% dividend yield, you're getting 3, 4, 5%, it's just not going to make sense. Investors are going to rush right in there, drive the price back up, and that dividend yield is going to come back down. So the idea is that dividend payment is a bit like gravity, and it's always going to kind of pull the price back to it if it gets too far out of line one way or the other. Last, Brookfield. This is another big position in the Akre portfolio, and they're an alternative asset manager. So the main thing they do is they invest in and they manage real assets like real estate, infrastructure, renewable power. They also manage assets through private equity and private credit. So they earn the majority of their money from owning these assets and from managing money for others. The interesting thing with Brookfield, they're really more of a holding company. They don't actually run the business. They just own businesses or pieces of businesses within that main structure. So again, pretty solidly up moving revenues and operating income. You can see the operating income is steadier than the revenue. Interesting thing with Brookfield is they do tend to once in a while spin something off. Like I think the most recent was Brookfield Asset Management was spun off the main corporation here. So there's really, if you get into this is a very complex company. There's a whole ecosystem of Brookfield investments that you can explore. But as far as why it can keep compounding, well, they have a massive global investment platform, and more governments and companies are going to need more private money for big projects. They're going to be a part of that. And they have a very strong history of smart deals and value creation. They've got a really great reputation, and they have lots of room to reinvest their profits into long-term assets that are going to grow in cash flow. The kind of things that they do are necessary, and that demand is going to grow into the future. Just think about that renewable energy and the infrastructure. With this AI data center build out, Brookfield is probably going to indirectly benefit from that as they build some of the infrastructure and power generation necessary to run all those data centers. Now with Brookfield, as I said, they've spun some things off. The company structure is complex. The accounting can get a little messy. So I did not do a dividend yield here. What I did was I just looked at price to operating cash flow because I thought that was maybe a better metric to look at Brookfield. Arguably, we can maybe use a price to book, but it looks similar to our other charts in that it's trading not at a ridiculously expensive valuation at this point. Looks pretty reasonable compared to history. I mean, if you think about it, for a company of this quality to pay 10 times cash flow, that's not a bad deal at all. So these three companies, they're all steady compounders. They can keep growing into the future. They're all fairly easy to understand. Like I said, Brookfield's structure is a little complex, but what they actually do is pretty easy. They put up money, they build infrastructure, they own real assets, they invest in real estate, and then either they operate that business or they lease out the real estate, and they take the profits and they reinvest into more. These all have long periods and long runways where they can reinvest, and they all keep getting stronger over time. So these all kind of benefit from some kind of a network mode if you think about it. So when you start buying life science products, for example, your whole staff is trained on those. Your whole supply chain is based around the products that need to go into those. Your studies are done on those. And if you want to do follow-up studies, you should probably use the same equipment. Otherwise, you introduce a variable that you might not want to deal with. Moody's has that fabulous reputation. Same with Brookfield. And the bigger Brookfield gets, the more money it has to reinvest, the bigger projects it can do, the less competition there is there. So these three, I think, are interesting compounders right out of Chuck Akre's portfolio. And with that, thanks for watching. Hope you enjoyed it. If you have questions, put them in the comments. If there's other companies you saw in Akre's portfolio that you think maybe meet what I was looking for better, again, please let me know in the comments. And thanks for watching. See you in the next video.